More dollars flowed out of the country in the second quarter and first half of the year to pay for importation of goods and services. This as the central bank reported a higher balance of payment deficits in such period, which Jillian Geronimo details in this report.
The country registered deficits in its balance of payments, or BOP, in the second quarter and in the first half of 2022. Data from the Bangko Sentral ng Pilipinas showed the BOP deficit at $3.6 billion in the second quarter, a reversal from the $905 million surplus in the same period last year. Meanwhile, a higher deficit in the overall BOP position of $3.1 billion was recorded in the first half of 2022. As the peso hit an all-time low of 57.18 to a dollar last week, the Department of Economic Research explained how a depreciating peso would affect BOP positioning.
For the BOP accounts, a depreciating peso, all else held constant, will imply a higher import bill and also a higher cost of servicing debt.
BOP is the difference in total values between payments into and out of the country over a certain time period. A deficit position means more dollars flowed out of the country to pay for the importation of more goods and services than what flowed into the country in the form of export revenues, business process outsourcing earnings, tourism receipts, and overseas remittances. The central bank has also revised its 2022 BOP deficit projections to $8.4 billion from its previous estimate of $6.3 billion in June amid key external challenges such as rising global food and energy prices and the continued economic slowdown in China. Jillian Geronimo for The Nation.